Welcome back to EDU-Tutor. Today we will be looking at limited liability companies. We're going to be looking at some characteristics, advantages and disadvantages, and how the limited liability company is formed. What do we mean by limited liability? So, limited liability refers to when an individual is not personally responsible for the business debts and obligations. Therefore, if something happens and the business goes bankrupt, the owner of the business will not be held liable, so they won't have to spend their personal assets to finance the business debts, right? So, a limited liability company is a company or a business entity that has been incorporated. That is, the company has a different or a separate legal identity from the owner. These are companies in which the stakeholders are protected as they will not lose their personal assets if the business goes bankrupt. So that's what limited liability means. The investor or stakeholders are not liable for the debts of the company beyond their level of investment. There are two types of limited liability companies. The first one being a private limited liability company, or you can have a public limited liability company. Now, let us start by looking at the private limited liability company. So, whenever somebody says they have a private limited liability, that company only allows friends, relatives, and co workers to purchase shares or to be a part of the company. The privacy of this company is protected because, unlike the public limited liability company, it does not have to publish its balance sheet in the newspaper. So, legally, the private limited liability company can only have a maximum of 20% and a minimum of 2. What are some advantages of having a private limited liability company? So the first one, a larger capital base than that of a sole trader or partnership. So they have a maximum of 20 persons who are investing into the business. So a sole trader only has one owner and a partnership can have a lesser amount than a private limited liability company. Therefore, the private limited liability company would be able to get more capital from its owners. The company has continuity, thus can obtain loans easily. What do we mean by that? So, because if a member or an investor dies, the company will not be affected. So, therefore, it has continuity and it can obtain the loans easily because persons will be more interested in investing in that company or lending them loans. The company has a separate legal identity than its owner, and therefore it has limited liability. What are some disadvantages, though, of the private limited liability company? The first one, the capital is limited since membership is limited to 20 persons. So, if we had more persons in this company, we would be able to get more capital. But since we only have 20 persons, it is limited. The company must file reports with the Registrar of Companies. No, the company also sells shares, but is restricted to only the private grouping. So only the persons who are within the 20 persons who are members can buy and sell shares. Now we're going to be looking at the public limited liability company. So how is it different from the private limited liability company? Now, the public limited liability company is a company that allows members of the public to buy shares. So anybody who is a part of the public can buy shares. The shares or stocks of public limited liability companies are traded on the stock markets. And in Jamaica, our main one would be the Jamaica Stock Exchange, right? They have a minimum of 7 members, and there's no limit to the amount of persons who can join a public limited liability company. Therefore, they have a larger capital base. Advantages of the public limited liability company: it is easier to obtain financing because, as we said, they have a larger capital base, and also the fact that persons would be more interested in lending money to this type of company. Shareholders have a limited liability, so if anything happens and the business goes bankrupt, none of the shareholders will have to sell their personal assets to finance the business debts. Shares can be quoted on the stock exchange and sold to the public. The company is able to grow and obtain economies of scale, and changes in stakeholders and directors will not affect the continuity of the company. So, similar to the private limited liability, if somebody dies or one of the stakeholders decide that they don't want to be a part of the company anymore, then the company will still continue to operate. Disadvantages of the public limited liability company, though, is that the legal requirements may be costly and time consuming, because we're going to be looking at the steps to forming the limited liability companies, and you will notice that there's a lot of things that these companies have to do, right? So it's very costly and time consuming. The accounts have to be made public. So this is a company, the public limited liability company is the company that have to publish their balance sheet in the newspaper. Due to large size, decision making is very long, and differences in opinion may develop among owners and directors because everybody won't agree on all the decisions. These companies lack a personal element because there's so many owners, so there's no personal element there. Now we're going to look at how the public limited liability company and the private limited company is formed. So the legal procedures for both these organizations are very lengthy, and they must submit several documents. So the Companies Act contains laws relating to companies. To comply with certain requirements which are laid down by the Companies Act, the promoters of a company must present several documents. And we're going to be looking at all of them. There's 7 of them, so we're going to be looking at them. The Memorandum of Association is the first one, and that has the company name, the address of the company's registered office, the objectives of the company, statement that the liability of the shareholders is limited, and authorized share capital, and the types of shares to be issued within that company. The second item or document is the Articles of Association. This will state the procedures for calling an annual general meeting, rights and obligations of the directors, procedures governing the election of the directors, statement concerning the borrowing power of the company, and procedures for dealing with the payment of dividends. The third document that they must submit, all right, then the third item that they will have to produce is a statement of authorized, registered, or nominal. This is the amount stated in the Memorandum of Association, which is the maximum amount which the company is authorized to raise. So the maximum amount of capital. The fourth item is a prospectus, and this is an invitation to the public to buy shares in the public company. It contains detailed information to enable investors to estimate its prospectus. It is important that the public should not be misled. The fifth item, statutory declaration. And these are declarations that are commonly used to allow a person to declare something to be true for the purposes of satisfying some legal requirement or regulation. The sixth item, certificate of incorporation. This is a legal document relating to the information of a company. It is a license to form a corporation issued by a state government. And lastly, the certificate of trading. This is issued by the registrar of companies to the public limited companies to grant permission to commence its business. All right, so thank you for watching. I hope you learned something new. And if you have any questions, put them in the comment section below. Thank you.